Hey everyone, let's dive right back into our ASC 230 cash flows training. We are now on section 3 of 7, tackling operating activities and the indirect method. Now, if you remember our last explainer, we laid down the groundwork, right? We defined the core vocabulary, what cash and restricted cash actually mean, and we introduced the major sections of the statement. Well, today, we're taking that vocabulary and connecting it to the actual physical mechanics of building the operating section. We're going to look right under the hood of ASC 230 and reverse engineer our way from accrual-based net income to the true, unadulterated cash hiding inside.
Here is how we're going to logically unpack all of this today. We'll start with the default cash engine, look at a few classification elections, walk through step 1 on non-cash adjustments, then step 2 on working capital, and finally wrap up with the direct method reality.
All right, section 1, the default cash engine, and why operating activities literally catch everything else.
So your operating section is, by definition, your default bucket. It tells us the most important story of all. Is the company's core day-to-day business actually generating or consuming cash? And this is entirely independent of how the company is financed or how it's investing in future assets. It is the ultimate reality check for a business. Now, you should know that errors in cash flow statements almost always happen because someone incorrectly moved items out of this operating section to artificially inflate their operating cash flow. It's kind of the oldest accounting magic trick in the book. So when you're categorizing a transaction, you have to ask yourself, does this clearly and undeniably belong in investing or financing? Because if there is any doubt whatsoever, it's operating.
Moving on to section 2, let's look at the 3 classification elections, really the only areas where ASC 230 gives us a choice.
Now, as you can see here, things like interest and dividends received actually offer you some classification choices between operating, investing, or financing. But, and this is a big but, consistency is key here. Once you pick a lane, you've got to stick with it and proudly disclose it in your accounting policies. However, look at the bottom row. There is a strict, unbreakable rule. Dividends paid are always, without exception, classified as a financing activity. There's no alternative election. It's literally the one item on this list where the rules leave absolutely zero room for creativity.
Okay, section 3, step 1 of the indirect method, non-cash adjustments. Basically, removing what didn't actually move cash.
So, to reveal that pure operating cash flow, we have to strip away all those complex layers of accrual accounting. Because let's face it, accrual net income is full of noise. Promises to pay, non-cash expenses, weird timing differences. It's a bit like trying to find the real fruit juice hidden inside a carton of mostly artificial fruit punch. This is a 2-step process. Step 1 focuses completely on identifying and removing items that changed your net income on paper, but never actually involved a single dollar moving in or out of the bank account this period.
It's actually fascinating how logical these add-backs are when you just pause and think about them. Take depreciation, amortization, or impairment losses. We add these back to net income because, well, they dragged our net income down on the income statement, making our profits look lower, but no actual cash left the business this month to pay for them. The cash outflow for that equipment happened way back in the past. Same thing for stock-based comp. You paid your employees in equity, not cash. Or amortization of debt issuance costs. The actual cash was paid when the debt was issued, which is a financing activity. So we just add all these back to neutralize their negative impact on our starting net income figure.
On the flip side, there are items we absolutely must deduct. Why? Because these falsely inflated our net income on paper without generating any actual cash for the core business. Think about unrealized gains on investments. The market value of your portfolio went up, so your net income went up, right? But you didn't sell anything. You didn't receive a dime of cash, so we have to deduct it to get back down to reality. The exact same logic applies to deferred income tax benefits and equity method investment income. They're non-cash earnings pickups. They make your income statement look fantastic, but they do absolutely nothing for your actual bank balance.
Now, this brings us to a major trap. The most frequently missed non-cash adjustment is the gain on asset disposal. It absolutely must be deducted from the operating section. Think about it like this. Say you sell a company delivery truck at a gain. The full cash proceeds from selling that truck, every single dollar you received, belongs way down in the investing section of your cash flow statement. But because you sold it at a gain, that gain is currently sitting up inside your net income. If you don't aggressively deduct that gain right here out of your operating section, you are literally double counting that cash. You're counting it once in operating through net income and a second time in investing proceeds. And trust me, nobody wants to have to explain double counting to an auditor.
All right, moving right along to section 4. Step 2, working capital. This is where we adjust for timing differences.
The logic for working capital relies entirely on understanding opposite behaviors. An increase in an operating asset uses up your cash, so we deduct it. A decrease provides cash, so we add it. Conversely, liabilities are the exact inverse of that. An increase in an operating liability provides cash, so we add it. A decrease uses cash, so we deduct it. Honestly, if you can just memorize this fundamental seesaw relationship, step 2 becomes incredibly straightforward. It's really just tracking the physical lag between making a promise on paper and actually signing the physical check.
Applying these rules to real-world accounts is super logical. Let's say your accounts receivable balance increased. What does that mean? It means you earned revenue which boosted your net income, but your customers haven't actually paid you the cash yet. You are technically short that cash right now, so we must deduct it. On the other hand, if accounts payable increases, it means you recorded expenses that lowered your net income, but you haven't actually written the check to your vendor yet. You kept your cash, therefore we add it back. Every single account here, from inventory to deferred revenue, follows that exact same timing logic.
But once again, we have a huge trap to watch out for. Working capital changes that come from business acquisitions must absolutely not be included in your operating section. Think about it. If you buy out a competitor, you're naturally going to inherit their accounts receivable, their inventory, their payables, the whole shebang. But acquiring those balances is an investing activity. If you accidentally just dump their working capital changes into your operating section, you will drastically overstate your true core operating cash generation. Always separate out those acquisition impacts.
Okay, bringing it home with Section 5, the direct method reality, and why the indirect method we just learned is the one that actually prevails.
So both of these methods arrive at the exact same final net cash number for operating activities. There's no difference in the bottom line. However, the indirect method is the overwhelming choice in practice. Why? Well, because you can build it directly from your standard accrual accounting records, exactly like we just did in steps 1 and 2. Now, the FASB actually prefers the direct method, where you list out the actual cash receipt from customers and cash paid to suppliers, because honestly, it's way more transparent. But here is the punchline. If you choose the direct method, the rules still require you to build a separate indirect reconciliation anyway. So the direct method's supposed simplicity is basically an illusion. You end up doing double the work, which is exactly why almost everyone uses the indirect method we covered today.
So, what does this all mean? Well, you've officially mastered the default operating bucket and you know how to strip away the accrual illusions to find the real cash flow. But what happens when the business needs to make a massive purchase or take on millions in debt? Are you ready to classify the actual lifeblood of business expansion? Keep all these principles we discussed today fresh in your mind because we'll be tackling investing and financing activities in our very next explainer. See you there.